So rather than digging through the details of the company balance sheet or income statement, you can use these ratios of values found in these reports to determine the health of the company's performance. There's three general types of accounting ratios. The first that we're going to talk about is liquidity, and this measures a company's ability to pay obligations as they are scheduled to arrive. The second would be effectiveness. This measures the effectiveness with which a company utilizes its assets. And the third will be profitability. This measures the company's degree of success in generating profits. There are three liquidity ratios that we're going to talk about in this lesson. The first one is the current ratio. The current ratio is equal to the current assets divided by the current liabilities. It reflects the ability of the company to pay off its current debt. The next ratio is quick ratio. This is the quantity, current assets minus inventory, divided by current liability. It reflects the worst case picture of the company's ability to pay off its debt because it removes the inventory. Therefore, unlike the current ratio, it shows the ability to cover debt if the company is unable to convert inventory into sales. And the last ratio is operating cash flow. Operating cash flow is net income plus non-cash expenses, which normally represent depreciation, plus the change in working capital. A change in working capital is the current assets minus the current liabilities. And we take that quantity and we divide it by the current liability. This represents the number of times the company can meet its current debt with generated cash. Now, everything that we need to calculate these ratios we find on the balance sheet. The balance sheet shows current assets, cash, current liabilities, inventory, and our current income. In our lesson creating a balance sheet, we created a balance sheet for XYZ from a ledger. Let's use that balance sheet to take a look at the ratios. Let's take a look at how XYZ stacks up. We'll start with the current ratio. From the balance sheet, XYZ current assets are $2,700. It's holding $14,800 in cash, and its current liability is $2,200, making its current ratio right around 8. This means its current assets are 8 times larger than its current liability. So the good news is they've got no issue here covering short-term debt. However, a ratio this large makes me wonder, why is it so large? And in this case, it's because they're holding a lot of cash. And then that makes you ask the question, is this the wisest use of a cash resource?
Now let's look at the quick ratio.
As before, current assets are $2,700. Cash is $14,800.
Inventory is $1,950, and current liability is $2,200.
Right, so this makes the ratio right around a 7.
But with basically the same observations we had from the current ratio, no issue covering short debt, but the company seems to be sitting on too much cash.
And since the quick ratio differs from the current ratio by about 1 point, it indicates that almost all the current liability is due to inventory. Now for operating cash flow, our income to date for this period was $300. Non-cash expenses were 0, and the change in working capital, which was our current assets minus our current liabilities, well, our current assets were $2,700 and our current liabilities were $2,200. Calculating the ratio comes out at 0.36. This means that XYZ did not generate enough cash flow this period to cover its expenses. This example demonstrates why so many companies go to operating cash flow first.
Let's share with the students some follow-up lessons we have that can help them continue with their transition to management.
Yeah, that's a good idea, Daniel. The first lesson would be creating a balance sheet. Make sure you review the lesson on ledger entries, effectiveness ratios, and profitability ratios. If you enjoyed this lesson, like us on Facebook, subscribe to our YouTube channel, and visit our website.